Hi and welcome to this week's edition of Macro Minutes. I'm your Head of Trading, Mark Gardner. The information summarised in this webinar does not constitute financial or professional advice. It's general in nature and does not take into account your specific circumstances and should not be acted upon without a full understanding of your current situation and future goals. Okay, so stocks in our universe this week, we've got ZipPay, or Zipco, ReadyTech and Smart Group. We'll start with Zip. It acquired the minority shareholding in Zest Money for $50 million in a similar strategy to the investment in QuadPay to build a truly global buy now, pay later business. Zest Money is India's largest fully automated AI-driven buy now, pay later operator with 11 million registered users, over 10,000 online merchants, and a presence in over 75,000 stores. India has macroeconomic tailwinds of a low but growing percentage of online shoppers, 10%, a young population with 50% of the population less than 30, and a transformative digital payment ecosystem with robust expected growth in retail and e-commerce markets. Zip's share price increased about 5% on the reporting on the day, ending the day around 683. Trading above $7. They've gone into an agreement with Microsoft to be integrated into their Surface yesterday as well. So it's fairly decent things going there for Zip at the moment, and we should hope to see that. They've been flagged as a bit of a potential takeover target like Afterpay, so maybe worthwhile having some of those. Obviously going to be affected if Nasdaq's been a little bit weak lately. If we might be slightly affected in any drop in the Nasdaq, but overall doing the right things there. Next up, we've got ReadyTech Holdings. They reported an acquisition of Avaxa on the 27th of the 9th. They'll be expanding their presence into enterprise education marketing through the acquisition of Avaxa for a total consideration of $2.2 million, funded from its cash reserves. Avaxa is a specialist enterprise student management software supporting Australia's leading enterprises, including two TAFE clients of Chisholm Institute and the Melbourne Polytechnic. We're expected to deliver incremental recurring revenue in financial year 21 of $670,000, which is 1.254% of the total revenue, with an EBITDA margin of 15%. The ability to acquire competitors strengthens RDY's offering and competitive advantages, increasing RDY's market share in the education segment, notably services provided to TAFE. The share price increased by about 5% on the day of reporting, ending the day around about $3.57. Next up, we've got Smart Group. On the 29th, they received a non-binding indicative proposal and entering into an exclusivity arrangement to be acquired. So that was from TPG Global LLC and Potentia Capital. They're looking to acquire 100% of SIQ. Under the proposal, SIQ shareholders will receive total cash consideration of $10.35 a share, reduced by any dividend or return of capital paid before the implementation. This represents a 31.7% premium of SIQ's closing share price on the previous day of $7.86 and a premium of 38.6% from the 90-day volume weighted average price on SIQ shares. They intend to unanimously recommend that shareholders vote in favour of the proposal, subject to several conditions, including completion of due diligence, agreement to terms of the implementation, and no superior proposal or independent expert support. They increased by 18% on the day of reporting, ending the day at $9.28. Alrighty, we've got the trading stock of the week. So BetMakers recommendation was released yesterday, and look, this is a technical trade. We have recommended this before on that. When it fell away mid-July there, technically the trading recommendation was stopped out there, but most clients sort of held on as at the time it was just an options exercise from the Waterhouse Group, and it bounced out quite well there. If you'd been generous with your stop, you basically would have been getting out in the high teens there for a win of about 17 or 18%. It went on with the job really from that point in August. So only pulling back once, then going up to about a high of around about 141, 142. With the markets just backing off a little bit in the last over the last month, we've seen it drift back off to the 200-day moving average here. 105 is a pretty decent area, as you can see. There's 3 levels of support there. Apart from that fiasco with the with Waterhouse exercising his options and selling, flooding the market with shares at that point. We see this as it's a good long-term investment, basically. Given that the US is opening up their gambling legislation, so they're being awarded constantly, new states in the US for gambling. So this is a pretty good area to be buying it again here. Stop is around about 90. It can be quite thin, like the last time. You can probably be a little bit flexible on your stop depending on, on what's going on at the time. But we should probably see this quite easily, launch back up to that sort of 140 area. Not a huge clip size there, probably 70%, maybe even slightly less if you'd like. The conviction's quite high and the risk reward ratio is quite good as well. So realistically this time around, if there's short of some exercise and options or something wildly out of left field, that that stop level should be pretty solid down around that area. It's just a good short-term trade there. Rightio, stocks to watch out for in the next week. We've got Sims Metal, ARB, and Ridley Corp. We'll start off with Sims Metal. They announced a 50% franked dividend of 30 cents a share, going ex-divi on the 5th of October, payable on the 20th. The dividend yield of 3% at current prices. They're a global metal recycling company that's involved in recycling, processing and coordination of selling recycled goods. They reported strong recovery from lows in financial year 20, which is largely due to reduced demand and low scrap availability. It reported financial year 21 sales revenue up 20% to 5.9 billion. Statutory profit rebounding 186% to 229 million. During financial year 21, they announced the acquisition of an existing recycling facility in Australia, as well as progressed through development approval for 2 new facilities in Queensland and Victoria. Their performance remains vulnerable to COVID-19 impacts. However, in the medium to long term, the increased demand for steel-intensive infrastructure will boost supply of the SGM scrap inputs and recycled metal outputs. Furthermore, the global pursuit of decarbonisation of steel production will continue to be in SGM's favour. And obviously with vaccination rates getting above 70%, that COVID impact is going to be lessening more and more all the time. So with China pulling back their coal production of steel with iron ore, the iron ore price has fallen back quite heavily, as has some of the iron ore miners. So that should be pretty positive for SGM overall, because with the infrastructure bills going through, we're going to have to get our steel from somewhere. So I dare say SGM will have fairly favourable tailwinds for the next 12 months and ongoing. Next up, we've got ARB. They announced a fully franked dividend of 39 cents a share, going ex-divi on the 7th, payable on the 22nd. Dividend yield of 1.42 at current prices. They design, manufacture and distribute motor vehicle accessories, light metal engineering in Australia, US, Thailand, the Middle East and Europe. Their sales in all customer categories grew significantly, leading to growth in sales revenue of 33.9% to 623 million. Statutory profit up 97% to 112.9 million in financial year 21. Notably, the sales growth of overseas and original equipment channels rose over 30% more than the Australian aftermarket. Consequently, ARB has continued to diversify its operations into those 2 rapidly growing channels, with exports representing 36.7% of ARB's sales. Following the acquisition of UK vehicle the acquisition of UK vehicle products company Truckman in the last financial year, management are confident they can maintain strong performance in the future with increasing geographical revenue and diversification. They pretty much with used cars prices rising, Upgrading your current car with the supply chain shortages for new vehicles is obviously going to help them with tailwinds as well. So basically, I think National Tyre and Wheels was another company that really benefited from that as well, with people just upgrading their existing car because they can't get a hold of a new car. Next up, we've got Ridley Corp. They've announced a fully franked dividend of 2 cents a share, going ex-div on the 7th of October, payable on the 29th. Dividend yield of 1.48 at current prices. They're a company that produces and markets animal nutrition solutions. They've added new brands that service the companion animal market, which enjoyed COVID-19 tailwinds and spend on pet nutrition and veterinary services boomed. Their EBITDA rose by 16% in the financial year to 69.1 million. NPAT turned positive, rising 333 to 24.9 million in financial year 21. Strengthened balance sheet following the sale of excess feed mills and investments directed towards RSC's sustainable strategies, as well as supply chain optimisation. Moving into 22, management expects continued EBITDA growth over the next year, while also commencing commercial trials of their Novak products international expansion process. Their price rose 8% from the previous close to $1.23 when the report announced that the dividend was released. Right now, looking ahead over the next week from more macro economic standpoints, we've got OPEC meeting, RBA rate statement, and US unemployment. So next Monday, OPEC's set to meet for their biannual meeting. The nations represent 40% of the world's oil supplies. They're unified dictating the world's oil supply. These meetings are held to discuss the future supply levels and can have a significant impact on oil prices. Currently, we've got a bit of an energy crisis going on. There's a gas shortage in the UK. Petrol stations running out of petrol over there. Oil prices been rising fairly significantly. Just on the back of those, there's been hurricanes in the US and things as well, which has reduced inventories over there. So it has been quite well. We're at 3-year highs in oil prices, so you probably would expect them to increase production, but you never know with OPEC. They're pretty random in what they do in their decision-making process. They've had a few blues lately at that level, being able to increase production bases for some of the fringe countries. So hopefully they won't be having any sort of uproar at this meeting, which will further push oil prices higher and obviously increase inflation and things as well. Next Tuesday, 2:30, the RBA will release its rate statement. There'll probably be a bit of an update in terms of what they're doing with their bond purchases, etc. They've continued to reduce their bond purchases, even though we've had the lockdowns. Obviously, now we are going into Freedom Day, as they're calling it, like copying the UK, around about the 11th of October in New South Wales, with the rest of Australia lagging a little bit, but fairly close. They generally will, we don't see any movement in rates. There'll be a statement, but most of the RBA's communications really out there at the moment. We wouldn't be expecting anything major to come out of this meeting, unless they're going to get more aggressive in bond purchases. So there's also talk that Josh Frydenberg was going to try and clamp down on income to house price ratios and crack down on the housing market a little bit, which is sort of going to do the job a little bit for the RBA in a way, because they are worried about rising house prices getting way too hot. And so that actually may help the RBA in making a few decisions there. They'll be able to slow down the bond purchases potentially, or at least keep pace. Next Friday at 11:30, and this is obviously changed by an hour because of daylight savings. We'll have the non-farm payrolls. It is a lagging indicator, however, it's very, very significant. If we get a good number, it's pretty much going to give the green light for the Fed to start tapering in November, or announce tapering. So yeah, look, this will be very closely watched. anything around expectation is really going to give that green light. So that's probably going to, not be great for the stock market, particularly the tech sector potentially. Basically because we're going to have rising interest rates. Those, that tech sector generally is the one with the inflated PEs, which, with rising interest rates, we're going to seem far less attractive. So definitely one to watch out for. There's a number of issues sort of broadly going on in the market at the moment. We've got Evergrande going on, the Chinese property giant that is potentially, or is about 30 days away from defaulting on bond payments. China's got some energy sort of rolling outages and more blackouts, you could call them, going on. You actually can't use your heater or microwave over there at the moment. They're trying to reduce energy consumption to basically fit in with their their climate change goals, or carbon emission reduction. So we've also got obviously the gas shortage in the UK. We've got dropping consumer confidence in the US as well. So then again, we'll hopefully see the fairly decent jobs data over there. And obviously the debt ceiling decision has to be made as well. So the US basically has their end of financial year as of today. So we may see some erratic movements in US equity markets. Maybe some selling to lock in some capital gains for the next financial year rather than the previous one. But overall, the debt ceiling will basically reduce the US's ability to pay bills, wages for government employees, all sorts. So it'd be quite catastrophic if they don't get that sorted out. We have been to this point before in the debt with the debt ceiling. Usually it's just been raised, but it's just a bit of posturing and a bit of bargaining going on between the Democrats and Republicans and moderate Democrats as well. So, which may see the infrastructure bill be pretty heavily reduced, which will reduce stimulus as well, which is not going to be necessarily great for the market either. So there's a lot going on at the moment. Well worthwhile keeping up with your macro updates, etc., and the trade recommendations. Look, if the market peels off from here, we've drifted off to 4-week lows recently. On the index, I think we're technically looking for support around the 6,900 area, and then at an extreme, a 6,600 area. But we'd really only be looking at that being a mid-cycle pullback, which is probably fair enough given we've had 18 months of pretty heavy upside. So it'd probably be more than likely quite healthy for the market to pull back and take a little bit of a breather. But overall, the economic conditions, I think, will be fairly favourable as we start to reopen. So thank you for attending the Macro Minutes, and we will chat again next week.